Welcome back to the On the Tape podcast. Now, we've had some incredible guests over the years. Is that true, Dan?
Lots
Nathan?
of incredible guests.
But we have a Hall of Famer, an institutional investor, right? II Hall of Fame.
15 years.
Every year.
Yeah.
And you get I think you get sort of put in if you make it for a certain amount of time.
Probably get a couple of those lucite plaques here and there.
Got to get them.
Yeah, something like
Well, I mean, Marko Kolanovic, thank you for joining us. Former Chief Global Market Strategist and co-head of Global Research at JP Morgan, joining us here on the tape. An honor to have you. You joined us on Fast Money numerous times. Here you are with us on the tape, Marko.
Thank you so much, guys. Thank you for having me.
It's great.
So much going on in the world as we're sitting here, S&P at basically 6,000, which I never in my wildest dreams thought we'd get to. A NASDAQ making all-time highs, seemingly enthusiasm on the back of this election. A lot to dissect, but let's just talk about it through the lens of the market. Mm-hmm. What are your thoughts here as we sit pre-Thanksgiving and S&P at 6,000?
So 6,000, and I look at it through the lens of multiple, right?
Mm-hmm.
So if you want to look at the backwards trailing 25, forward looking, clearly we don't have, nobody has a crystal ball to know earnings, but, even the optimistic folks will tell you it's 22. I happen to think it's even a higher multiple than that, So multiple is high, and you put that in a historical context. Look, for instance, even the first Trump presidency, right? Multiple was sort of 17, went from 16 to 18, right? That was a big rally, right? We're now 23, let's say, right? So multiple is high, right? So what would justify such a multiple, And you would really need to have almost, I think, everything going perfect, right? You would need to have sort of a smooth, peaceful transition. You would need to have sort of some global geopolitical stability. And you would need to have this like a perfect soft landing and reacceleration, and pick up so earnings can grow from these levels at a brisk pace, So that's in isolation in U.S. Now if you look at the sort of U.S. versus the rest of the world, one sort of call it factoid, interesting fact, U.S. market cap is now half of the world global market cap, right? So concentration is there as well. So you have like a high multiple in U.S. You have this relative crowding also from other assets and other equity markets. So I think everything needs to go really well for that to be justified,
Through the lens of history, 25 trailing, put that in context for people. I mean, they hear that without context, it's hard for them to understand if it's rich, if it's not rich.
So again, trailing is always a little bit a weird measure because you really don't know, what happens. But let's look sort of what people expect as a forward. Forward, historical long-term average is below 16. It's like, I think, 15-ish. Depends how backwards you look. More recently, last decade, it was kind of between 16 and 18, And then we had this like a COVID massive monetary stimulus. Then it shot up to 22, right? So basically, we're now at the highs that we had at peak of that a COVID rally, post-COVID rally, right? So it's unusual, right? Because even back then, you could say interest rates are zero or negative. We just went from very big sort of market disruption from COVID. So you could expect earnings will grow. We also had a tech kind of excitement back then with ARK, if you remember, and all these Zooms and so on and Peloton, so on and so forth. So right now we're right at that peak, right at the top, and I just don't see as much what can go now better than so far or already it is. So again, historical multiple, call it 16 to 18. So that would be, so let's say now we take 22, 23 forward looking. So that's like 20% expensive to some historical average where the rates were actually even lower than now, right? But if you look at the bad times, when you have sort of slowdowns, recession, it drops down to 12. So I'm not saying we're going to recession, but let's say you allocate some probability of that,
Yeah, we saw that, I guess, in 2022. So we had an earnings recession. We did not have an economic recession. And I think X those top 15 or 20 names in the S&P 500, the other, let's call it 480, they troughed at about 13 times, if you took the aggregate of all their earnings. So you just mentioned the concentration that's kind of bugging you a little bit. It's kind of bugged us a little bit. You just gave the percentage of U.S. equities to the global kind of equity total. I think the Mag 7 is like 11 or 12% of that. So as you think about, like, let's say, that concentration here in the U.S., does it start to bother you more as you're starting to see some of those names kind of cool out a little bit? That would be Microsoft. That would be Google. Apple never confirmed the new highs in the S&P 500. NVIDIA is driving a lot of the train. Tesla just joined the party. So there was a couple laggards there, and then there's some that are not trading particularly well, underperforming the S&P right now.
No, so the concentration was sort of something that we were frustrated for the last sort of 2 to 3 years, and it's still there, right? So valuations are there, expectations are there, and hence one could make a case. So let's say this call it Trump's presidency 2.0 becomes like that rotation, kind of deregulation, pro-business, maybe some cutting of taxes or whatnot, right? Which would help sort of the X of Mag 7s, right? So everything else relative to Mag 7. And then one can also envision potentially some scrutiny with some of these mega cap tech names, so think of Facebook, think of Google, even the AI stuff, right? One could see some headwinds, potentially even regulatory headwinds, So and we had a lot of headlines there. So I think there is a case to be made for rotation. There is probably a case to be made that some of these, and this is now a little bit more subjective, that some of the AI hype of sort of ordering, double ordering, triple ordering, expectation, and I know a little bit from being in that industry, how people get excited about things. They immediately say, hey, look, let's spend a lot of money. Let's, we can't be behind. We can't be perceived to be behind. There was a lot of sort of hype. People wanted to show and talk about on earnings call what they do about AI. So they don't have a problem spending a lot of money. Now we need to see what that's going to deliver.
The return on investment. So one of the things what's interesting about that guy, he's got to be one of the very few strategists who's actually talked about that. And I think that's really interesting because, the Silicon Valley mantra was like ask for forgiveness rather than permission. And that's something that really was prevalent in the sort of startup culture. But now it's worked its way into some of the largest market cap companies in the world. And so they were benefiting from multiple expansion based on CapEx, based on the promise of, what will come in the future. And that's what's a little dangerous to me because it's again and again, we keep hearing about what are the use cases? What is the return on investment for Microsoft's Copilot deploying it throughout, this and that, whatever. We don't know yet. We're not going to know for a couple years probably.
I agree. And again, I have been on that cynical. I have been wrong. I'm not sort of hiding, but to give you a little bit of background, in 2016, I wrote a book on AI in asset management and finance, right? So machine learning and AI. So I was really sort of someone who saw that as a great opportunity early on. So it's not that I'm not educated about it. I'm just a little bit skeptical how much can deliver. And you mentioned some of these products. I kind of test drove all of these products and I got to the point to say, hey, okay, this is nice to have. It has its pros and cons. It can actually mislead you in something, it can give you some very confident results, which ends up being wrong. So sort of, sure, it's going to evolve. It's going to grow. It was growing in the last decade already. I mean, all of us use AI in our phones, cameras,
Guy doesn't, by the way.
I'm waiting for it to improve.
His iPhone 3 is not,
yeah. So it didn't happen all sort of last March, right? With so I was just I'm still a bit more just realistic that it's going to be a bit of a period where things will cool down. Maybe this order will have a hiccup, and then some of the sort of multiple can hit a air pocket, right? And for that matter, then the whole market can hit an air pocket. So I see that as a risk. I think a lot of that was sort of driving, obviously, past year, the market. So I don't see it as a future upside. I see it more as a bit of a risk. So
I'm going to try to sort of synthesize some of the things that you said. You talked about the U.S. total equity, so the Wilshire 5000, which, by the way, I don't think there are 5,000 stocks in it, but it's the Wilshire 5000. And Warren Buffett, something that he looks at it, it's that investable market, which is now north of $55 trillion, I think, divided by U.S. GDP, which gets us at north of now 202%. His warning sign comes in about 130%, which is one of the reasons, Marko, I think he's now has $325 billion of cash sitting on their balance sheet. You mentioned something, though, in the magnitude of the U.S. versus the rest of the world. It is now more than half of the investable markets globally, with China being second, and U.S. is about almost 5 times the size of China for perspective. So my question to you is, some people look at that and say, that's a good thing because the U.S. should be in sort of the catbird seat. Other people say that the magnitude of the lead of the U.S. vis-a-vis the rest of the world, and Wilshire 5000 divided by GDP, those are all warning signs of a magnitude we've never seen before. So what is right and what is wrong?
I happen to be, it's hard to say, what's going to happen, but I happen to be in the camp to say it's a warning sign.
Right.
It's a warning sign. Now, if you want to be in other companies saying it's an opportunity, then there is a case to be made for rest of the world investing, right? For, ROW, right? So you can sort of, you can probably, and truth never ends up being sort of black or white. Usually it's somewhere in between. So probably one could risk manage and maybe slightly turn more cautious, take some chips off the table from US. And if you still are bullish in the global GDP cycle, and if you don't think that we're going to have some sort of confrontation with China that's going to derail that, then maybe rest of the world is a place to be, to sort of overweight. As I said, I see it as a slightly more negative. The clearly market was more or less straight line up 25% this year. So far it's been wrong. So hard to pound the table, but maybe that making the tilt out of the Mag 7s and maybe even frankly out of the US in equity bit. Yeah. And I would overweight sort of some assets. Bonds are still yielding. Yields have widened recently. So maybe it's not a bad place to be, just perhaps even to weather this transition in the next few months, to see how the sort of new government settles in. What are the because we will have that headline with, tariffs are coming, right? And we saw that in 2018, right? Market doesn't like that. So I think that moment will come at some point, right?
Yeah,
Not too far from now.
Great point about 2018. We've discussed that a lot, especially because, it was Jerome Powell. He was appointed by, then President Trump. We have a similar sort of situation. I think it's a little bit more tenuous this time around. But when you think about the U.S., let's just say, versus a China, we've been waiting for that Chinese engine of growth, to be turned on since the pandemic. And it's really never sort of hit. And when you think about just the situation that they're in domestically, and then you think about a heightened trade war, what would that mean if China were to weaken from here? What does it mean for global growth in general?
So that would, obviously would be a headwind. It's not out of the question. I think there's going to be some first confrontation or some first a bit of the erasing of tensions, only to have some sort of deal at a later stage, right? And what Trump sort of did in 2018, he started introducing this uncertainty to the market, thinking that uncertainty is going to strengthen his negotiating position. So sort of he's putting other party off of the balance, and he's going to get a better deal. Unfortunately, VIX repriced higher and market multiple repriced lower because of that uncertainty, right? So I'm not sure that uncertainty might be good for negotiation. It's not good for, I think, market multiple, So I think that is going to happen. So maybe we have a little bit of now some sort of honeymoon period. Market rallied a lot, and looks at the positives and we'll get the negatives as well. So the first presidency back in 2016 to 2020, you had those first 2 years where it was a honeymoon period, and then the trade war started 18 to 20, and it was just a constant volatility, constant ups and downs, not good sort of for equity investors.
Let's play a little geopolitical, and I'll go down the list of 3 different things. We'll start with Russia-Ukraine. One would think that the likelihood of forcing both Russia and Ukraine to the negotiating table has been accelerated in a meaningful way. What does that look like through the lens of the market if Ukraine would have to concede certain things, and what does that mean going forward, in your opinion? Because that seems to me the most likely outcome.
So I agree that's a sort of a more likely outcome in the sort of destination, but process to get there might be bumpy, both domestically here and also with respect to sort of European allies, and perhaps even within Ukraine internally. So I'm not sure it's going to be perfectly smooth, right? The smooth sort of process would be that somehow Trump basically tells, hey, you guys need to make a deal, and you're going to lose some of the territory. And that's it. And European just says, okay, fine, this is new policy, and let's get over it, right? I'm not sure. I think there's going to be first internally within U.S. opposition of sort of ceding very quickly the grounds to Russia after so much investment from Europe, from obviously Ukraine, number one, then from Europe and U.S. So I know people would just say, "Hey, okay, we kind of lost, right? And let's give them what they have now, or perhaps even more." Could also be from Russia. I mean, keep in mind, Russia has been in this war, invested a lot, human capital. They suffered a lot as well, Ukrainians, and they may not also say, "Hey, we want to now." Also,
we want it out. That's interesting that they might not want the off ramp.
No, they want to say, "Hey, look, we now have a quote unquote upper hand or perception of upper hand, so we're going to go a little bit more further." I don't think they'll go further, much further outside of Ukraine, but they could within this war go further. So they may not also immediately jump on this thing, right? And I do put some risk that there is going to be domestically a bit of a sort of turmoil as well. That's not going to be that easy for Trump just to say, "Hey, I write off Crimea, or I write off these four, districts, right, the regions." So eventually might go there, but there could be some sort of internal soul searching of Europeans, right? We'll see what's happening in Europe now. Germany, Eastern Europe versus Western Europe. There are a lot of divisions there. So I'm not sure that Trump will suddenly unify all of these forces and they will say, "Okay, you got us," and Russia, won whatever little thing they won there, right? Or a lot.
Part 2, geopolitics. Looks like Mike Huckabee is going to be the ambassador to Israel. If you've listened to him over the years, he doesn't even acknowledge that Palestine exists. He doesn't talk about occupied zones. He's seemingly as hawkish as one could be in terms of that. That plays to Israel's benefit, I think. How does it play out here? Does it give Israel the an open door to do something with Iran? Like, how does this play out, the Middle East now?
I think, certainly plays a bit more in that direction, right? And they can, be more, take a more harder stance. Now it remains to be seen what the response of Iran is. Good chance response of Iran is going to be kind of to pull back, to sort of, but, as a few weeks back, their foreign minister said, "Hey, we have a bomb. We have all the technical capabilities to do this, to make a bomb, right? We just need religious leader to kind of sign it off from religious aspect," which is kind of a little bit of BS, right? When they have it, he'll sign it off, right? So that's an unknown, right? So they can pull back now, but we could still be surprised down the road and say, "Hey, we do have this bomb," right? And then decision will need to be made. Does U.S. and Israel go there militarily, and how that ends up, how it impacts global oil markets, right? So initially gives Israel a bit upper hand. I do think Iran will probably pull back, but I don't think they'll sort of stop with their nuclear program, right? So one way or another, it's just time when these things will escalate. Rather than it's somehow miraculously going to be resolved, right? Now, speaking of this geopolitical, I mean, and I'm sure you're going to ask about China, but if you look at the sort of this Trump's presidency and his vision of foreign policy and the sort of the previous government or the current government, right? A vision of foreign policy is different in so much that I believe Trump wants to sort of quote unquote shorten the front of a U.S. global presence, right? So he thinks that U.S. is unstable internally and needs to fix that, whether it comes at the border, southern border, whether it comes to these internal divisions, these cultural wars and whatnot. So he feels that that's a priority, plus globally shortening the front. So he would sort of shorten the front in Ukraine, right? So kind of cede that part, but he's not caving on Israel and the Middle East, right? That part of the front he will keep, and then Taiwan,
So let's talk about that, because obviously China's had aspirations for Taiwan for quite something. They're very vocal about that. If you look, I mean, the rhetoric seemingly gets ratcheted up, and some of the movements militarily have been ratcheted up as well. If you follow, which you do, President-elect Trump has recently said, Taiwan's going to have to pay for themselves in terms of their protection, which I think is part of the plan of getting Taiwan to buy like bombers and arsenals and those types of things. It sort of makes sense. How much more likely, though, given this new administration seemingly laissez-faire attitude about Taiwan do you think a China-Taiwan situation is?
So she gave his timeline, right? So while he is the president, he will integrate it. I think he'll do. I think he'll do it probably quite a bit before his end of his presidency to be able to sort of get a fame for it. And so I think he'll do it. The timeline of that is sort of anyone's guess. Logic would be that while the U.S. is stretched, Western alliances are stretched in Eastern Europe and in the Middle East now, that sort of towards the end of that, they may actually they may jump in, right? Could it be, so if there is no solution, I do think that Trump will probably try to quote unquote broker some deal, which might be simply some sort of transaction where he will get something from China for some timeline of integration. And because keep in mind, a few years back in the first term, Trump was on record at one point say, hey, look, this is sort of throw of a stone away from China and 10,000 miles or kilometers from U.S. We're losing this, right? This is a lost battle. Philosophically for him is, okay, why do we need, put aside sort of political, but look at the sort of the geostrategic or even economic, okay, we need the semiconductors. Trying to say, hey, bring them here. It's more jobs for U.S. nationals, and we don't have that exposure. So I think Trump was very much sort of willing to call it, again, quote unquote, sell it. And put it as a part of some deal. So it's possible that might become part of his whatever great bargain with China will be. But that's going to, I think, come after a lot of back and forth punching and negotiations and headlines moving the market. So I do think eventually Trump could sort of broker some deal, effectively long-term seed that ground for you.
So it's interesting. Yeah. So in essence, our reliance upon Taiwan would theoretically go away if they were to bring basically chip manufacturing here to the United States. It's been a plan all along. The problem, of course, is it doesn't happen overnight. I mean, these things typically take 7 to 10 years to build out. But it's fascinating. So then my final question to you is, what is the likelihood of all three of the things we just talked about sort of working out in a Goldilocks scenario?
So that will be basically, so Trump first needs to sort of establish his governance here in the U.S., which might not be perfectly smooth process. But let's say he does that fully, right? His instinct will probably be to, they were going after him, and I think he'll probably go after some people as well, right? So first, that process needs to kind of go without any major, tail events, say for the U.S., right? So if that happens, I think Trump will first a little bit twist the arm of sort of Zelensky to broker some deal. I think he's going to play tough on Iran, and draw a line there. And I think he's going to be working on this sort of China deal, so I think, and again, this is my gut feeling, this is my guess, I think Trump would probably give up on parts of Ukraine, give up on Taiwan, put this new shorter front
in the Middle
East, and call it fix it internally until U.S. is strong again to start regaining the ground again, right? So I think because they say, this country is falling apart, immigration, we are invaded, whatnot. So his mentality is that we can't afford sort of this level of global footprint.
Let the chips fall where they may, Russia, Ukraine, to a certain extent, China, Taiwan, shore up things in the Middle East, fix things at home.
Yeah.
What are the growing pains in the market, if any, on the back of that you just talked about?
So it could be volatile, right? It could be volatile, and we need to sort of, I think the sort of, the whole AI and calling Mag 7 is a parallel track. I mean, some related, NVIDIA and some of these things are related with also global exports, but but that probably multiple would have to in the process deflate a little bit. I think there would be ups and downs like 2018 and 19 with are we going in a big? He would, he's going to bluff. He's going to go with big sort of headline grabbing news that market is going to freak out, right? So it could be really period of time, like 2018 to call it 20. I mean, forget about COVID, but X of COVID, right? The period of time where you have more volatility and sort of the honeymoon is over, right? Almost like honeymoon now it's going to last like 1 or 2 months. And we had this like AI honeymoon and Powell honeymoon from December. Really, he did really signal to markets I'm going to ease, and market kind of took it, right, and ran with it, right? Like, so almost like everything was probably front-loaded in this multiple, right? So now I think it's going to be some EPS growing pain to grow into that multiple with some, call it geopolitical unsettlement and introduces some volatility. So I saw some of these strategies are putting these long-term returns pretty low, right? Goldman, I think, then, so so it could be this type of environment that sort of equities go back into their historical trends or slightly below historical trend. And keep in mind, S&P return on average 6-7%. It's not 25.
No.
Year to date, we're 25, right? So yeah, maybe we can have like a few 1 or 2 years until this plays out, a return like 4-5%, and then your bonds are yielding 4 or 5%. Now in equities you get some more volatility, so it's not so overall I'm not as excited.
Yeah. Well, I think the base case, just to kind of put a button on that geopolitical stuff, is that a year from now, it's probably all in a pretty similar sort of situation, if you think about it, right? Because your point is it's going to take Trump, let's say, 6 months domestically to get things in order. You got to get a lot of these cabinet people approved and the like here. The Republicans are going to be jockeying around on a whole host of things. I think it was interesting that they did this, blind ballot, and they chose someone to be the Speaker of the Senate that wasn't somebody that was on the top of Trump's list, right? So, and then if you think about some of the folks that he's nominating to be Secretary of State, Rubio is a huge China hawk, right? You think of the guy that he's suggesting that's going to run defense. Well, he wants to pull out of Ukraine. It's interesting that the Speaker of the House, Mike Johnson, is the one who pushed through that last Ukraine aid bill. So I think a lot of that stuff is going to take a while to play itself out. Yeah. So the idea of kind of investing or trading the market, on those sorts of things, I know that would just be one input. It doesn't seem like that's something that's going to change all too soon. But let's go back to Powell for a second. So he's supposed to be into the end of next year, right? Or into the beginning of 2026. Trump's going to put a lot of pressure on him. Maybe it's just he realizes there's not a whole heck of a lot he can do. Let's just say inflation stays pat. Let's say growth doesn't really accelerate here. Let's say rates stay where they are or go a bit higher, because the fear is that you see a reacceleration of inflation. And let's say the dollar stays here or goes a bit higher. Aren't those all? And then obviously tax cuts, fine, they get extended, but they're already here. You know what I mean? So deficit spending, all that sort of stuff. Isn't that really bad for growth in general?
I think it is, right? As you said, dollar euro now is 105, right? So give or take from the bottom, 10% rally, right? That does impact EPS, and then as you said, despite the fact that they cut how much they cut, rates are still restrictive, right? And I'm surprised that sort of the more things didn't break. I mean, we had a little bit of breakage with commercial real estate a while ago, right? We had a little bit of Japan hiccup this summer, but overall, we did not see yet, the impact of those restrictions. You see it in real estate in New York City. You can't sell. You can't. Everything is frozen, right? So you see it like in little places, but no major a slowdown of consumer yet, and that may as well come, so to your point, Powell will have a lot of say in that, right?
Have we hit, in your opinion, that soft landing though? So we have, unemployment at 4.1%. We have growth at about 2.8%, right? We have inflation. I know cumulatively is cumulatively, but we're below 3% or so. Does that feel like a soft landing?
I mean,
to you?
It's so. I was not a huge believer in soft landing, so for me, hard to sort of say it is a soft landing, right? So I would a little bit also point that you had this asset. People look at their 401ks and suddenly they are, there's record number of millionaires, right? Look at the Bitcoin, 90,000. I mean, that's like $1 trillion of paper wealth created on a short notice, right? So asset prices and asset valuations, I think, have contributed a lot to this, what we kind of call soft landing. So I'm not sure if that's like a proper soft landing or still a little bit of a sugar high from the sort of 25% in markets, and some of these other assets, which could still turn out to be a go towards slowdown or worse if there is a confluence of factors. But certainly. There was no recession, right? That's a fact. So
Dan mentioned the unemployment rate, and over the summer the Sahm rule kicked in. Claudia Sahm has since backed off on that a little bit. I don't think she's as steadfast in her belief that it actually was triggered. Doesn't matter. We've gone from about 3.4%, I think, at its low in the unemployment rate. We could tick to 4.3. We're now 4.1. So her rule was triggered. My question to you is, regardless of whether or not that is a leading indicator or an indicator at all, is the unemployment rate something that you're watching? I can speak for myself and say I'm one of these people that believe the unemployment rate has surprised people to the upside and the market's not prepared for that. What is your thoughts on the job market?
So, same, I was watching closely, state by state, second derivatives, the jolts, all these things, right? And it was all sort of trending in this, call it, bearish direction.
The wrong direction.
In the wrong direction, right? And it was also a sort of head scratching, why market seemingly care less. Market was very much focused on the sort of Powell's pivot on the Mag 7. There was sort of always explanation why the multiple should be higher because of the new technology, the fifth industrial revolution or whatever you want to call it, right? So people didn't look at it, right? Like so we were, or I don't know if you were in the same camp, but we were a little bit proven wrong. That hey, short term it doesn't matter. It seems like it doesn't matter now. That's not the only one. You look at the consumer, the defaults, credit defaults out of
yes.
all of those things as well, right? So I don't think sort of soft landing is now, a verdict and no risk of inflation whatsoever. Of recession whatsoever. I think risk is still there, but not at these level of asset prices. You will need to have a bit of a sort of a feedback loop, that you get markets down, you get crypto down, you get, then people would suddenly worry about it again, So now there is still excitement about crypto. There is excitement about markets. So it's not going to happen in the next few weeks, or probably this year is going to be fine, right? With the seasonality, and eventually people close their trading activities. So it could be something sort of maybe past Q1 or Q4 earnings season, right? Could be that those fear resurface, right? But I don't think we are sort of out of the woods, with the direction of some of these indicators.
Let's talk real quickly about Fed funds rate for the last, year and 3 quarters has been on average about 5%. Let's say, okay, so we've taken it down 75 basis points from the upper bound. Let's just say they don't come down. You just called it a little restrictive, or I don't know if you said a little, but it's restrictive right here. The stock market, in that time period is up 55% or something like that, right? So I guess how does the stock market continue to go higher if rates are not going to go much lower, right? Because they lowered, the Fed funds by 75 basis points since September, and we saw what the 10-year did, right? Yeah. So what's the bull case from here, assuming that not a whole heck of a lot changes, right, with monetary policy and the like here? What's the bull case for stocks right now?
No, so I think it's my bull case is that, call it at best case the average annual return of 6%. I think it's actually lower than that, right? I think we front loaded that, especially these last, from let's say 5,800 to 6,000. If you look at this election seasonality, it's a pretty good seasonality that people de-risk into election. Now it was actually no de-risking whatsoever. It was just up and then more up, right? So I think that part was front loaded by at least few percent, 2-3%. And hence, if your average returns is 7%, I would say 4 to 5%, right? That'll be my sort of bull case. It's.
But your point is where yields are, that's not a great risk reward.
That's not a great risk reward, right? Yields, and if something goes wrong, yields will go down. I think if there is some global scare.
Well, there'll be a flight to quality in the form of U.S. bond, without question. The flip side of that coin is what might go wrong is the U.S. bond market. So that to me is what I don't think the market is pricing in. I think the optimists are saying yields are going higher because the economy is going to get better. I think other people are saying you're missing the boat on this. It's all about debts and the need to basically issue more debt going forward over the next 3 years. I think $15 trillion or something that needs to be issued. That's why people like Paul Tudor Jones and Stan Druckenmiller are short the bond market.
Yeah, no, there's other as you said, school of thought sort of that Trump will be inflationary. the fact that he was twisting Powell's arm in December 2018 to cut, not to hike. Right now they were like a little bit unhappy that Powell cut, because going into election it kind of juiced up the market, which in theory should have helped Democrats more. So I'm not sure that Powell will suddenly become that Trump will suddenly become disciplined and say, hey, Mr. Powell, just why don't you keep it restricted, because I want to stamp out inflation So there is a chance that inflation actually just gets entrenched and nobody really cares to fix it. And then also these geopolitical developments keep it running, where bond yields could go up more, right? Equity would at some point crack. People always say, what is that number? 475, 525. But it's somewhere there. It's not.
We haven't spent much time on this really quickly. I think this is when we talk about all the potential risks. I mean, let's just say Trump, because he doesn't really seem to have any guardrails on him. They have the House, they have the Senate, he's got the Supreme Court. Let's just say he walks in on January 21st and said, pal, you're out. What are they going to do? I mean, he's out. And then what if they make the Federal Reserve political, right? And they basically start lowering interest rates. That could be an absolute disaster. If you think about how foreigners view our debt, how they, and that is actually one of the more likely sort of hiccups. Here's a guy who has no shame. He doesn't care about repercussions. And that's not an opinion. That's just true, right? So, is that a worry? Do you have that up on the list there?
No, it is everything sort of geopolitics. It's on the list, right? And we saw a bit of a preview there again in the winter of 2018 to 19. He did come up with some. There was a headline kind of, "Hey, I'm going to fire the Powell," and then I think Mnuchin came back. No, he was just joking, right? Because I think market dropped a lot, and so he did that already, right? So he could do it. He could do it as well, right? So uncertainty around Fed and some sort of interference there could produce volatility, right? Simply Trump could make his policy of keeping the deficit high and not caring about where the interest rates and not caring about stock market, right? Because he cared a lot. Apparently he cared a lot about stock market in his first term.
Because he had to run again.
He had to run again, correct? And he was a little bit also on a thin ice with levers of power. He didn't have them. Now he has them. Right? So he could, in a sort of populist fashion, say, hey, you know what? Most of people sort of actually don't have a lot in stock, right? In my base. So, and they hinted slightly. I mean, I think Elon said something like, look, if we cut the government spending, might not be short term,
near term,
right?
Yeah.
So that could be another surprise. Any kind of beef with Powell could be a surprise for the market. And then then you can have. We had a lot of crazy events past 12 months, right? Like, who knows what could happen? Right? You could have something really out of the left field happening there, right? That reminds me of 2020. If you remember 2020, what type of protests we had, and it's not our question. That doesn't repeat, right? So it's on the list, right? So these are all domestic risks, and then you have these international risks, and then you have a cyclical risk, employment and stuff like that. And then you look at multiple lists, I call it 25 backwards, 23 forward, and you just say it's kind of not there. Now, I do feel bad, right? Because, this last, 10% run up, since August, right? Was sort of, I didn't see that coming.
Many people, I can only speak for myself. I clearly didn't as well. But,
speak for me.
Again, it doesn't mean the things you're concerned about haven't gone away. And that's the point I've been making a while. It'd be one thing if the market were rallying because all our concerns have been assuaged somehow and things changed. The only thing that's changed, Marko, is the S&P 500. What hasn't changed, though, is my admiration for you, and I want to thank you for joining us here on the tape.
Thank you so much, guys. I really appreciate it. I'm looking forward to it again.
Yeah, I hope so. All right, welcome to the On the Tape podcast. I'm Dan Nathan, joined by Danny Moses. Danny, how are you?
I'm good, Dan. Great to be in the studio.
All right, we got a lot to cover here today. Guy was just with me, but he's not going to be here with us for this portion. He and I just had a great conversation with Marko Kolanovic. He is JP Morgan's former chief market strategist. We went all over macro. We did a bunch of geopolitical stuff. He gave us a bit of his outlook and how he's thinking about the markets right here. You and I got a lot to do here. It is Thursday into the close. We got a big expiration Friday tomorrow by the time you're listening to this. A bunch of single stock stuff going on here today. Some news out of Amazon, some news about EV credits. Disney put up a big quarter. I know there's a bunch of other stuff you want to get to, but as we are recording, Fed Chair Powell speaking in Dallas. What did he say, and what does it mean to you, Danny?
So he basically is in Dallas and saying the economy is really strong.
Yeah.
Doesn't see a real reason here to cut rates. Didn't say he's not going to cut rates, just like he doesn't feel compelled to do it.
Mm-hmm.
The one comment he made, which is interesting to me, is I'm just reading this now, is inflation is running much closer to our 2% longer run goal, but it's not there yet.
Mm-hmm.
I think people had felt that as long as it was kind of trending that way. So you take that with kind of the economic data we've seen recently when inflation has started to stop going down, right? It's kind of ebbed here. So kind of a wait and see. You know, the Fed Fund futures, I haven't looked in the last few minutes, but we better than 50%, I believe, still for next month.
So it's about the CME FedWatch tool has it at 59%. But that is down.
That was 90% literally a week ago.
Correct,
and
91.
I think we're 3 cuts then through 2025. I think the Fed Fund futures are pricing in 3.75%, right? And we're sitting here roughly at 4.5, range of 4.5 to 4.75. So that's a big change. And listen, the good side, the upside is the economy is strong.
Yep.
Earnings are reflecting some of this strength. We're going to get into some of those names here. But again, it's a little bit of a wake-up call. That's the first time Powell kind of, I would now call his cut last week a hawkish.
Yeah, but go back to the questions that he got in the presser on November 7th about whether his job was safe or not. And we just talked about this with Marko a little bit. I think one of the underappreciated risks going forward, at least in 2025, is that let's just say Trump just decides to fire him, okay? Like for all intents and purposes, he puts somebody in there like, I don't know, Matt Gaetz-esque, you know what I mean? And all of a sudden, he starts pushing around interest rates at the exact wrong time, you know? So Fed Chair Powell's kind of being smart about this. If he doesn't see inflation where he wants it to be, if he sees an economy that's still humming along, he sees the rates where they are, where the dollar where it is. I mean, that's like an ingredient for, you know, like reigniting inflation if you start pushing down Fed funds rate.
For sure. And I think what he may have said it, again, haven't seen it live, but we're talking about credit spreads in general. We've been talking about this thing for weeks. It's been the big driver, easing financial conditions, so to speak. He must see them to himself without saying it. There's the easiest that they've kind of been. So he's sensing that there's a little bit, maybe too much euphoria in the marketplace. And so, you know, just to this week alone, credit sites downgraded kind of the U.S. high yield market. Credit spreads haven't been this tight for, 20 something years. Like you are basically seeing an abnormally high number. So when we talk about credit spreads for people that are out there, everything's kind of based on Treasury yields and just use the 10-year yield in general. So everything is kind of measured off of that. So in order to take the appropriate risk, you should be paid a higher rate than government securities, right, to take on risk of an investment grade, and therefore even more on high yield, kind of triple B rated. And you're not getting that in credit sites, reasoning. JP Morgan also put out a very similar note as well on it. So something to pay attention to, I think.
Yeah, so last night, this would be Wednesday on CNBC's Fast Money. It was Carter, it was Guy, it was myself. Mel kind of went around the horn. We talked a little bit about what was going on in the market, and she said, oh, well, you guys all sound a bit bearish. And to be frank, I'm not that bearish here. I'm really neutral because, again, there's so much uncertainty here. There's very little that seems is going to take the stock market down. Seasonality, we have 6 weeks or so until the end of the year. And my take, Danny, was like, until we get into the new year, I don't see any reason why people would start selling stocks. Maybe there's some sort of event that we're not thinking about, but thoughts on that near term, because again, let's just say the anticipation, it keeps going lower and lower, the futures for a rate cut. Is that the sort of thing that could get some traders to say, or some investors to say, listen, it makes sense to trim some profits. We're up 25% of the year. Last year, we were up 25% of the year. I mean, how good is it going to be going forward in 2025?
I think trade-off is, can earnings grow enough to justify valuations in the market? It's that simple. So you can get the Fed pulling back a little bit as long as you get earnings coming in. But let me just, from a sentiment perspective, we've seen these bull-bear indicators now. They're pretty extreme right now on the bullish side. So you're always due for like a little bit of a correction, to your point. This is Bank of America survey, okay? The number of fund managers overweight U.S. stocks nearly tripled to a net 29%. And Citigroup said investors, pushed their exposure on the S&P 500 to the highest in 3 years. We always talk about how the chase begets the chase. And you get to this time of year, fund managers that are benchmarked to certain indices, they have to start chasing. That's what you see. To your point, what could happen that would cause something to really... a dollar just running like we're seeing unabated to the quarterback, so to speak, as we're seeing right now. The irony is that Trump's, kind of plan long term is to weaken the dollar. So you're seeing a lot of these mixed messages. And so I think people are still digesting not just the election, we're digesting third quarter earnings. And the good news, Dan, is there are certain sectors and certain companies that are doing very well. You can ignore the noise of the bigger markets, but you need to pay attention to it and be honest with yourself on investors getting swept up in buying these indices. What is that? Is that moving up your stock? And are you being honest with yourself that valuation is appropriate?
All right, so you just mentioned S&P earnings, and we think about what a disproportionate amount of S&P earnings come from those top 10 mega, cap tech stocks, and you think about how much of their sales come from overseas. Let's drill into the dollar here. So we have a Dixie that's up from about 100, very near 107 right now. So Danny, as we get towards the end of the year, as we start getting, companies reporting mid-January, late January for Q4, and you have a dollar that's stuck here, it's at the high end of a multi-year range here. Don't you think that has to weigh on some forward guidance a little bit here for some of those mega cap with multinationals?
Yeah, and it really is important to break that down even further. Dollar euro, and there's people now that think the euro might go to parity, might go to 1. I think it's down to like the 105 level. And then the yen. I'm not going to harp on that here. I don't have my partner Guy here to talk about the yen here, but we're back kind of 155, 156. And so you really need to look on versus other currencies. To your point, some countries sell more to Europe, some countries sell more to Asia, but in general, the dollar's having an impact on oil, the dollar's having an impact on gold, and the oil impact is really interesting because that has a real impact on the consumer. So I think the way to kind of read it in what is other things is it having an impact on
positive
and how to play
impact
that.
for the consumers.
Of course.
You have crude oil down
That's
at like
right.
$68. It's low, I think, over the last year, has been about 66 or so. And again, there's some, what's the news out of OPEC? They're
So there's
talking
two,
about
here's really interesting.
Yeah.
So IEA, which is one of the agencies, right? And then you have OPEC. IEA has always been more optimistic about the transition to alternative uses of energy, right? And so they've always played down kind of the oil demand because they thought there'd be other uses. So when you see the IEA raise their forecast, it's more because the market share is shifting between alternative power. OPEC is kind of the one you kind of want to go with, and they have been revising kind of lower the demand forecast. Again, a lot of it's China. It goes back to China. It's China.
Right.
A lot of, but there are potential.
So that's really important. So China's weak. We know that, and that's not likely to change anytime soon. They've kind of had a few bouts of stimulus, right, over the last few months or so, and it hasn't really, kind of got anyone particularly energized about what their contribution is going to be towards global growth going into next year. But you also have this hope, I guess, that Trump comes in and he's able to kind of calm things down in the Middle East. And again, I don't know if there's any sort of premium that's been put on the potential for that to get worse. And I think about, to your point, about the dollar move here. So crude oil, with what OPEC is telling you, I just don't see where there's a bid for it, Danny.
Well, again, I think there's a lot of other factors that go into it. To your point, geopolitics and so forth. So I don't know. I feel like we're kind of no man's land here at the 68 level. Kind of, you've had a nice call that it'll pull back. I don't see it going much lower than here, given geopolitics and given the fact that I think it's already priced in that China's weak. And I think the U.S. economy continues to show strength. If the U.S. economy were to weaken, right, I think that would change the landscape a little bit. All things being equal, I think it's fair value here. And I think it's interesting. The energy stocks themselves have actually, I think, outperformed oil itself recently. The quarters were okay and decent. And if you do get a move out of some of these high growth names, they want an excuse to go into energy. So my argument, flipping that, would be I feel pretty comfortable owning some of these energy stocks here. If you were to tell me that oil is not going to break kind of 65 here, then
all right. So this used to be an argument as we think about electric vehicles, right? So lower oil goes, the less interesting it is to own, right? Electric vehicle. If you're just thinking about the cost and all that sort of stuff. So Trump had been saying on the campaign trail in day one he was going to get rid of the $7,500 EV tax credit. And one of the things I think you and I have talked about, Elon Musk, his new bro, you know what I mean, is obviously should be very much in favor of those tax credits because his cars relative to a bunch of others, are very expensive. And then you think about price war that they've been in for the last, 2.5 years. His cars are very uncompetitive in China, but that's not where you get the credits here. I think we're kind of full up in those first users or those first movers who want EVs. Detroit's pulled back. Tesla is the option, but if they're going to be that much more expensive than other cars, when you have oil trading like this and gas at the pump going down. So talk to me a little bit about this because all of a sudden Tesla is for the what I mean?
Don't overthink it.
Yeah.
I know you know this, but don't overthink it. We know why. I've said this a few times in the last few weeks, why Musk cozied up to Trump is to make all these investigations, all the stuff go away. And as you've pointed out, and Kathy Wood has pointed out, if you can start to dream the dream on being approved for every regulatory thing, beyond getting out of all of his investigations, that's kind of what it's been trading on. But Musk doesn't. He's not thinking about what it means to the fundamentals. By the way, fundamentals of his company. When was the last time he was even at one of the factories? The guy's flying around. I think he's on borrowed time with this. I'm sure he'll still have a massive impact, but I think they're getting a little tired of him right now in Washington. But again, I don't want to trade it on that. I'm out of the name right now because it doesn't trade on fundamentals. When it does start trading on the fundamentals, I'm happy to jump.
Well, it's interesting, right? Yeah. So for the last year and a half, it's traded on the price of their cars and the competitiveness and, the margins and stuff like that. And a lot of the analysts who are very bullish on it, or a lot of investors who are very bullish on it, were saying it's about full self-driving and it's about autonomy. And so when you think about that margin improvement, which I think you, myself, and a whole host of other people thought in that Q3 that they just reported, there was something kind of funky going on there. But now, to your point, people are not going to care about EV tax credits and lower deliveries if they believe that full self-driving is going to come that much sooner because of the regulatory overhang is going to be pulled away. And then you can start pulling forward when autonomy comes. And that's how they're valuing it.
That's right.
That's why it's at $1 trillion.
You got it.
Okay.
That's it. Let's move on to some other.
All right, what do you want to do?
names.
Do you want to do Disney?
I do want to do Disney.
Right.
I think this is really, and I want to go. It relates to sports too, so I want to go into those names as well. But it's very, of course I do.
ESPN bet, baby.
ESPN, yeah.
Do you use that or no?
No one.
You're a FanDuel guy?
No one does. Well, when I'm in Florida, it has to be Hard Rock and only Hard Rock.
Right.
I'm up here. I'm actually using DraftKings.
How do you keep it all together? DraftKings is pretty good. I find
fine.
I find the user interfaces not particularly great. And you would think it wouldn't be hard to figure out how to make it.
What bothers
really
me is
slick.
when you make a deposit and it says congratulations on your deposit. I don't know what that even means.
Well, remember Coinbase used to do that.
I know.
One of the things, Coinbase actually, when you used to make a trade, they used to have confetti coming down.
Right. Should say sucker.
But the one
one
thing I'd say about Coinbase is they took something that a lot of folks did not understand, and they made it very easy for you to transact and to do it. And they had a lot of education. I thought it was a very good app. So my point is, when I go to DraftKings, and that's what I use, and I'm not like a crazy bettor or anything like that. It's just
not tactical.
It's not intuitive.
Well, it is if you know what to find. You're right, and they're getting better using AI to make it intuitive to almost send stuff out to you. They're working
you're
on
saying it's an AI play.
They are AI plays. Who do you think coming up with current odds? What do you think? It's a human being that's figuring these stats?
It's not Jimmy the Greek?
Yeah, exactly.
All right, so talk to me about Disney. Because, this thing, they reported the stock was up more than 10%. So here we are again. It's about 25 minutes into the close on Thursday. It's only up about 6.5% or so. What went on there, and what's so exciting finally for Disney? Because this has been a story, a bit of a train wreck over the last 2 years.
Yeah, so the streaming business obviously is now starting to make money. It was such a drain for so long. The sports content business is now evolving, not just because of gambling, because it's going to be more kind of a la carte offering on some of these streaming networks, and obviously Disney knows what they're doing in that regard. So that's what it's starting to trade off of. That should warrant a higher multiple than worrying about who's attending kind of the theme park and their movie catalog, so to speak. So I'm looking at the stock today, and I'm not involved in the name. It's interesting. If it was at $125 target where Morgan Stanley currently sits, that's 20 times 2025 of higher margin businesses that are growing. So all the money, listen, still have a large customer acquisition cost. They're still going to be buying content. But I don't know. You just made a reference at ESPN Bet, which is horrendous, by the way. And the irony of that is there's not a better sports content company than ESPN. They're going to get that right at some point. So I don't know, man. Like this is the 49th largest company in the S&P 500. It's in the Dow, not that it matters, but so it's widely held across the world. I think this thing's going to have legs to it. I think it's going to start to get revalued, a little bit of Netflix. So it's going to move from this traditional kind of company that it's been, and I think it's going to enter a new wave of shareholders.
Yeah, one of the things I think is tough here is that Netflix is a very simple story. It was about content creation. It was about marketing costs to actually gain subscribers, not just here, but globally, right? It was basically, one of the streaming services that you had to have, right? And one of the things that's become very apparent is that all these competing streaming services, they're really complicated, right? And so, and we know what's going on. It's been an arms race, and it's been a race to the bottom for many of the others. It's been a good place to be if you're Netflix, and it's been an increasingly better place to be if you're Disney, because they did just turn a profit for the first time on that. And then you can start valuing it, that one piece of the business. It becomes a better sum of the parts story. Is that?
Yeah, and say what you want. Listen, they brought Iger back in. Yeah. He's doing a great job.
Yeah.
The results.
Well, why is it that they're starting to float some names as successors? Is that just?
Well, I think he knew when he took it was going to be maybe 3 years, maybe whatever it's going to be. So Gorman's coming in, obviously, I believe,
as a chairman of the board,
and so whatever. Man, I want to make this move over so we just talked about sports content and media companies. DraftKings, FanDuel, which is Flutter, have put out numbers in the kind of over the last week. And what's really interesting is those are media companies also. And what's happening is they're starting to broadcast via Genius Sports, GE&I, which had a great quarter as well, BetVision and all these things. It's all kind of coming together right now. So kind of how you watch your sports, how you watch TV, how you watch everything has been evolving. And these companies, they're obviously very, very different, have been kind of coming at it. And what's really funny is Flutter, FanDuel, DraftKings, whenever you get a chance to buy these stocks on good sports bettors luck. So a lot of the favorites have come in the beginning of the season in the NFL, and we laugh, whatever. I said to you halfway through the season, or maybe a third, I go, I'm just going to stop betting and just buy the stocks of these companies because I want to be the house, whatever. You buy these companies.
I like that. Wait, so you want to buy the companies that
are making money? Exactly.
Why the house? Yeah.
You want to be the bookie.
Yeah.
Effectively.
So they've cut back their marketing.
Well, they have. They're still spending a lot, but they are, FanDuel is it's a better run company. It's much more diverse. And they're still the biggest.
Geographically, too, right?
Yeah.
So they're in Europe.
Geographically diverse, product diversity, everything, yes. And so I think 40% of their business is U.S., Flutter, but they're the biggest in the U.S. by far. And it's much cheaper than DraftKings. But again, the product offerings, so again, these companies, I think, are still not fully owned. And Genius Sports, just to finish out on this, obviously, they're the sports data play, Sport Radar and Genius Sports both had great quarters. And I think they're starting to get on people's maps here to take a look at these things. So again, still very positive. I know we've talked about those names. So
let's talk a little tech here.
Let's do it.
You kind of flagged ASML. So this is equipment company that about a month ago, they had one of the worst bookings forecasts that I've ever seen. It was down 50% from what they had previously guided to. The stock got absolutely destroyed. So now they come in, they report their results. The stock's trading up, 3%. I think it was up about 6% on the opening a little bit, which is basically, if you look at the chart, it's like a rounding error compared to where it's been in the last 52 weeks. And so I think about this and I say, okay, they came in and they talked up a big game as it relates to AI. Last month they said, well, it's the non-AI stuff. The market's not appreciating that. And then I want to throw in a couple other things here. So AMD, obviously a far second player as it relates to NVIDIA and GPUs. They're cutting some workforce here. This is a stock that's totally round trip the whole move. It was like a great AI play spring into the summer, and now it's all the way back and given most of those gains back. And if I think about this, AMD is down on the year, Danny. When you think about an NVIDIA that's still up to 200%. And then lastly, AMAT after the close. So by the time you are listening to this, we're going to know what their guidance is, what their bookings are. And I think this is really important because that's another stock that's well below its 52-week highs, and it's underperforming the NASDAQ and the S&P. So give me your 411 on
let me give you all these kind of tech names. So starting with, and I'm the last person that should be talking about tech, but let me give the shot. So ASML, to your point, a month ago, they gave out disappointing guidance. They're giving 2030 numbers now to get people obviously excited. So stock is a good, 10 to 15% off of its recent highs. And I do think that they're trying to make the business, just like AMD, no, we're going to move more into AI from all our other legacy businesses. So they want people. Cisco's really interesting today, right? They mentioned AI was mentioned 87 times on the call today.
And the stock can't even go up.
Right. So they beat numbers a little bit. They raised a little bit. It was fine. But they're not going to get more than a 22, 23 multiple because they're just...
Well, by the way, it has a 14 multiple right now.
Right. But I'm saying, but what I'm saying is all these companies in general... So again, you have this bifurcation kind of within tech in general. If I want to play AI and I want to go pure, let me just round out by saying this. Super microcomputer. We have been pounding the table about people to just be very careful for the last several months, ever since the Hindenburg article came out. Again, there's no reason to use SMCI. I'm not saying short it as a way to express your AI view. They can't file their earnings. There's a DOJ investigation now. Forget about it.
They're going to be delisted.
Just forget about it, right? But my point is this. People have made their bets on how they want to play AI. It's not necessarily through ASML. It's not necessarily through AMD. It's certainly not through Cisco. Those are ancillary ways to play it. They tried with Intel, but now it's a risk-arb play. So, again, we have a big number coming up next week with NVIDIA, right? And so AMAT I have no thing on, but Dan, you and I have been around the memory chips, and then there's PC, and then there's stuff. The legacy companies will always have to deal with the cyclical nature of those. The AI has been a secular play, and these companies, as much as they want to start shifting, and they have to a degree, until you see that till you see that kind of replace, I think these things they're fine. Everything has.
Let's talk about NVIDIA for a second. So their 4 largest customers are Google, Microsoft, Amazon, Meta, and actually I'm going to throw in Supermicro, SMCI. So if I look at what's going on in SMCI, so if that's the 4th largest customer, you have to think that if this company is going away, that's going to be a drag on 2020. Well, I mean, it will be. Because if Dell's going to take the share that SMCI lost, it's not like they're just going to automatically scale up, right? Or no?
Yes, but like we said last week, if an investor's buying into what NVIDIA is saying, which is there's literally limitless demand, right? Then you'll just shift that SMCI, you replace it. That's where the bulls will still say, okay, yes, you're right, but so I don't think people don't want to put the two together.
Right.
Maybe shouldn't put that's all.
But I'll just say this. So if Microsoft's one of the biggest customers, Microsoft has actually had not a particularly easy time convincing their existing customers to upgrade and use some of the co-pilots and the like. So if they're not getting the return on the investment as they build out their cloud businesses, they've invested heavily in OpenAI. The last thing I'll just say is Lina Khan is opening up an anti-competitive suit against Microsoft and how they're using Azure, their cloud business. Okay, so that's the sort of story that maybe that's why the stock is massively underperforming. It's up basically on the year half as much as the S&P and the NASDAQ is. Google not trading particularly well off of its 52-week highs. So it seems like some of the enthusiasm about this generative AI trade is waning a little bit. And then when you throw in a Supermicro and you have an absolute like dumpster fire there, that's one of the names that was very widely is affiliated or associated with this trend, you have to start getting your antennas up, Dan.
So I think when you look at the election, the change in administration, cabinet positions, Lina Khan probably won't be there. But more importantly, I don't think incrementally the tech sector benefited from what just happened in the election. Other sectors may have. So I think you're also seeing, Dan, just a reallocation. And these are $2-3 trillion companies. It's just the math is just harder and harder, and people are overweight them already. So to your point, I think that you're making is they're priced to perfection. And again, when there's missteps, you're going to see huge sell-offs. And that's why I say, in general, no matter what sector you're in, no matter what stock you're in, you buy a stock for a reason. You have whether you have an implied price target, whatever it might be. If the stock doubles, your position is now twice the size that it was, and the risk reward has changed, unless the growth can keep compounding. So it's a law of large numbers. And I do want to hit a couple other things.
Let's do it, Danny. It's your stage here, buddy.
Again, I know guys on here, we talked about the yen a little bit. I just have to touch on gold because it has had a pretty good sell-off, and you were dead on with your kind of 2,600 level that it could potentially go to. It feels like a slingshot here, though. It feels like the band's going to be pulled back to a point, and when it does make its move back up, I think it's whatever reason that might be, whether it's a dollar just selling off. It feels like it's a little bit more than that. It feels like you had probably a little bit more of the retail
about
frenzy.
8% drop from that recent high. Is that what we had?
Yeah, but what I'm saying is I think there was a late retail came in, and Liz has talked about it, but retail's really not there yet.
Right.
But there was enough froth that probably had come in. Gold, got to buy gold. They kind of said, I'm going to go buy crypto, whatever, do this thing instead. And then the dollar obviously is a mechanism when it's stronger that gold obviously sells off. I don't know. I don't see the dollar moving much higher from here. I could be wrong. If it does move much higher from here, we have other problems.
Why would you think the dollar wouldn't go higher if Powell just signaled that they're not a huge rush to lower rates in January and then you start getting these rate cuts pushed out in 2025? Don't you think the dollar should stay put here?
I think what will happen will be the rhetoric around tariffs and the rhetoric around, I think you'll see things being said that'll be toned down a little bit, only because when you want to change administration, you come in. I think it'll be more just speak in general that'll move it. I don't think it'll be anything that's actually occurring. So I'm just saying when you have a move like this so high, something has an impact. It starts you start to hear a little bit of noise. That's all. I'm not again. I could be wrong on that, but my point is this, Dan. If the dollar proceeds to keep going higher, there's other issues you need to worry about than gold. And if things do break down because then gold will go up on its own merit. Forget about its relationship to the dollar.
All right, so let's talk about, again, that dollar move, and you got the gold lower, but you've seen the exact opposite in Bitcoin. So really the move in Bitcoin from 72,000, I think it was trading like 70,000 on the eve of the election. And since then it's gone from 70,000, I think it got as high as like 92, 93,000 earlier today. This is all about really regulatory headwinds being pushed aside. And when you think about it, it never really proved to be a great store of value. Gold was actually outperforming it for a good part of this year as Bitcoin was going sideways between 60 and 70,000. Gold made new highs like almost every day this summer. So again, does the euphoria in and around Bitcoin over one thing, over the election, does that give you some pause? Because, we talked to Marko about this. When you think about the wealth effect, well, he just mentioned this. All of a sudden, you've had $1 trillion, and it's not just all here in the U.S. That's just of wealth that's just been created out of nowhere. And so I'm just curious, what is Bitcoin's move over the last week telling you about risk taking right now?
So I agree with the wealth effect. It's very important. I think
so. Lamborghini dealers are going to go crazy.
Well, the stock market and crypto in general. And I think what Powell said today in Dallas, without saying it, credit spreads obviously tighten on that as well. Just the amount of money flowing in. And so yes, think about this run in Bitcoin and crypto in general. The access during this bull run was never higher, meaning all these ETFs which you can own and all these things. The reason Coinbase is going up because they custody a lot of the stuff. So there was more ways to express it, rather than the traditional way, which really had issues in terms of your wallet. Where is it being stored? This is an easier way to do it. And I think that's what it is. So I think you touched the retail community. They had better access points to go buy it, and that's what's driving it. Now, saying that, they can easily sell those things as if they had bought them. So there is a level, just like in gold, bigger, I think, in Bitcoin, crypto in general, that you could see a pullback in Bitcoin for that reason. So I think you bring up a good point. And I think it's just access to be able to express the trade. Institutions can do it safely. They don't have to worry about
Well, you can hedge them. CME has.
Yeah, exactly. So I just think it's gotten to the point where it's matured enough to express it. But Dan, it is incredible that the hands that it's in have been very strong. I mean, we joke about HODL and all this stuff and whatever, but I think it's going to take a lot to shake the purists here at this point to start the ones that actually own it in their wallets, crypto wallets and stuff.
I mean, you can see through the wallet activity that there's whales that own this. I mean, the float is really small.
Right, that's my point. That's a better way to say it.
Yeah. So again, I just think it's an interesting thing to keep an eye on as it relates to sentiment. Carter Braxton Worth was on Fast Money with us last night. He was talking about the correlations to the NASDAQ. We've been bringing that up for years. Look what happened in 2022 when the NASDAQ was down like 35% or so. This got hit a lot harder. All right, Danny, we covered a lot of ground here.
Dan, I'm going to see you very soon. We're heading down,
Naples, Florida.
Heading down to the CME Group Tour Championship, right? That Terry Duffy.
Amazing couple days.
Amazing.
We're gonna interview Terry Duffy. He's the CEO and chairman of CME Group. You and I, we got a couple other things going on. They also have their GLFC. It's a Global Leadership Financial Conference. A lot of really interesting people. By the way, Vince Vaughn is one of the speakers.
No way.
Yes, I know he's one of
the
your
guy
guys.
that should have played me.
Yes,
not this Rafe Spall character.
What happened? That would be in The Big Short. And also,
wait, I get to meet Vince Vaughn.
Yeah,
that's going to be
George
amazing.
W. Bush is going to be one of the speakers here. A lot of really interesting.
Not
financial people. No,
oh no, that's the other one.
No, that's Jim Carrey. Yeah.
Sorry.
So so we're gonna be down there Monday and Tuesday. We're gonna drop a On the Tape podcast on Monday afternoon. Guy and I are gonna be on with Liz. That's gonna set you up for the week. So check it out.